and welcome to the 116th episode of the Veritas Fact-Finding Series. And today I'm joined by my special guest, Paul Musson. Good morning, Paul.
Morning, Anthony.
In each episode of our fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe that facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like, follow us, subscribe, and if you need more information, please visit us at www.veritascorp.com. By way of background, my name is Anthony Scilipoti, and I'm the president and CEO of Veritas, an independent equity research firm based here in Toronto, Canada. And proud to say, this year we're going to be celebrating 24 years, being 100% employee-owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas Group of companies may own securities discussed in this broadcast. While we love all our guests, and Paul in particular, this session may contain forward-looking statements, investment opinions, and comments that we may not agree with at all. Now, I'd like to give you a quick introduction of Paul. You know, Paul, his bio is really short. It says, you know, he has 30 years or over 30 years experience working in the investment industry. And most of that time was spent running Ivy funds at Mackenzie. And I was saying this morning at our morning meeting with my team here, how we're having this session. And two things really are exciting for me. You know, we need to showcase more of those professional portfolio managers that are Canadian. You know, we are here in Canada, we often, you know, we're following what Bill Ackman's doing. We're following what big name, quote unquote, portfolio managers in the US. We're Canadian. I'm going to continue to showcase Canadian portfolio managers that have made a difference. And in Paul's case, I would say he's made a difference kind of like Sundin ran the Leafs. You know, he's quiet. You don't hear a lot about Paul, but there was a lot going on for those 30 years, maintaining a consistent performance and a track record and a format. The way he managed the money was what I particularly enjoyed and always speaking with him. So, Paul, why don't I turn it over to you? We're going to go through your history, give us some good tidbits of what you learned from your over 30 years of experience in the finance industry, and especially here in Canada. Some advice for those people entering the industry today. We'll talk about your current views on the marketplace and stocks in particular, and we'll discuss your blog, which is very interesting. I'll save that for you to give your pitch, and the upcoming book, which is due to be published. So with that, Paul, why don't you tell us how you came into the investment industry and what drove your success?
Yeah, sure. Yeah, and thanks again for having me, Anthony. And, you know, we go back a long way. I remember when you just started 24 years ago, you came into the office and you had a cell on Nortel. And you were not too popular with a number of fund managers in Canada. And but I think that was an immediate bond that we had when we first met. So yeah, it's been quite a journey since then. How I got into the industry is sort of a long and circuitous route. I moved from Montreal in 1990, just looking for work. And I was literally sleeping on a hardwood floor of a bachelor apartment at Yonge and Eglinton. So no mattress, nothing, on the floor, pillow, blanket. My first job was in a video store at Yonge and Eglinton. And I was 29 years old. And so that's how I got my start. And then I got a job working for a subsidiary of AIG. I was a Kelly girl. It was a temporary maternity leave job, and got laid off. And then in 1992, I got a job as an assistant to a retail broker at Wood Gundy, Christine Timms. And I worked for her for 2 years, and she really helped get me on my way. She helped me get a job on the institutional desk at CIBC World Markets. And I was supposed to be a research associate under Mary Troop, who's another person who really helped progress my career. But that was 94, and that's when Greenspan started raising rates, and the whole new issue market plummeted and there was nothing for me to do, literally. And so Mary said to me, well, now you're, instead of a research associate, you're now a sales associate. And so I was contacting global fund managers across Canada, learning how to be a salesperson. I'm not really an extrovert, so it was a bit of a challenge. I remember the first event I did was a bowling event with fund managers. And I thought, it's kind of corny, you know, do I really have to call them and ask them to go bowling? And surprisingly, a number of them wanted to come. And remember Steve Way from AGF was one of them. And he ended up being a really great client of mine. Met a lot of really great fund managers and really good people. So it was a great learning experience, and it wasn't something that I anticipated doing. You know, but you need the job, you know, and give it a try, and you surprise yourself. And it was a lot of fun. And then Mary left, and then my boss was Brian Shaw, who was fantastic, and I had a really good relationship with him as well. And so I was really enjoying my time at CIBC World Markets. But when you get to know your clients, every now and then, you'll get a job offer from one of them. And so I got a job offer from one of my clients who was at AIC. And AIC was a fund company based in Burlington, and owned by Michael Lee Chin. You know, and it was quite a story in terms of the growth in their assets and the speed. And they had a very sort of distinct style as well. And so it appealed to me. And so I went and worked there for 2 years. And then one thing led to another. It really wasn't working out for me personally. It's just the way it goes sometimes. And so then I went to Mackenzie and started working with the IB funds and with Jerry Javasky. Jerry Javasky was like an incredible mentor for me. You know, it's not everybody in the industry is willing to share all of their knowledge and all of their experience and try to make you a better, not only better investor, but a better person. And that's what he did. And in particular, he taught me about valuation, how to value a business. And, you know, which I think is, personally, I think is the most difficult part of investing. Is our style, as you know, was to look for high quality companies. And high quality companies obviously are going to have good numbers, good return on capital, free cash flow, strong balance sheet, all this kind of stuff. And it's not that hard to find high quality companies. I mean, it can be tricky, but if you put your mind to it, you can find them. You know, you look for the good numbers, and then you have to identify how they generated those superior numbers. So you have to find out what the competitive advantage is. It's not always obvious, but often it is. And then, you know, a harder part than that is being confident that the competitive advantage is sustainable, that the company is doing the right thing to ensure that the business model thrives over time, that they are focused first and foremost on the customer value proposition. And so that's a lot of work. And you won't get them all right, but you'll get most of them right. But way harder than that is knowing what to pay for it. And particularly over the last, I would say, 15 years, where central banks entered the equation with the Fed put and the impact of passive investing and stuff like that. So Jerry taught me a lot about that. And Jerry then retired in 2009, and I became the lead of the Ivy funds. And, you know, not necessarily because I was the obvious leader choice. I think, you know, I was the oldest guy in the team, you know, at decent numbers. And so, you know, the previous guy leaves and said, okay, now you're the team lead. And so you kind of learn as you go. And yeah, I made a lot of mistakes as a leader, for sure. As a people manager, Well, I shouldn't say people manager, because I don't manage people. Like, I don't believe in managing people. Like, if you have to manage your people, then you got the wrong people. But there's still more than there's still a lot of things you should be doing. And, I definitely preferred managing money to the other stuff. So you kind of learn as you go. And yeah, and so it was a great experience. And I was team lead until I sort of left Mackenzie last year in March of 2023. And now and it was sort of a semi-retirement sort of thing, but I'm, I'm I'm working more now than I was then. And so I have established my own consulting company called Paddington Capital Management. And so I do have a consulting contract with Mackenzie, with my former Ivy teammates and friends. And so that's fantastic. I just love it. And Mackenzie's been really good to me. And it was a great place to work for many years. And then yeah, so now I'm doing other stuff. But you want to talk about the blog now, or should we talk about it later?
Well, why don't you give us your fondest memory from working at your time at Ivy?
Yeah, I it's really hard to pinpoint one memory. There were just so many things. I was honestly so blessed to work in this industry, to work with Ivy, Mackenzie. In large part because they leave you alone. To manage the money the way you think is appropriate for your clients and their clients. The appropriate manner with which we think we can get our clients to their long-term financial goals with less risk, less worry, less sleepless nights.
Mhm.
And that was one of our taglines. We say at Ivy, we lose hair so you don't have to. Let us do the worrying.
Mhm.
And so just the investment style I loved, the people I worked with, I learned a lot from and had so much fun with and traveled with. The wholesalers at Mackenzie, I developed a lot of great relationships with them as you travel across the country, meeting with the financial advisors. And I developed a lot of great relationships with financial advisors who I'm still in touch with to this day.
Yeah.
Great people. And yeah, so just pretty much everything. Doing presentations. I love doing presentations to our clients, and even there, you sort of learn, as you go over the years. I mean, at first, when I was first started making presentations, you're trying to get the money, you're trying to make a sale, and it's not that you're lying or anything like that, but you're trying to figure out what the audience wants to hear.
Mhm.
And and then, over the years, you start contradicting yourself. You say something, and one of your clients says, "Hey, Paul, but last year you said this." I was thinking, well, I don't remember saying that, but I can imagine myself saying that. And I just felt it's just the wrong thing to do. So I just stopped. I said, I'm not doing that anymore. I am just telling people exactly who we are, what we do, what to expect. And if you like it, that's good. If you don't like it, that's also good.
Mhm.
That's a good outcome, because then if you don't like it, but you think you do, then eventually you're going to figure out that you don't like it, and probably at the wrong time.
So, so
Right?
so what it sounds like, and if I can crystallize that, really in the money management business, you sell a certain expectation. And you offer, sell is the wrong word. You offer with your process, with the objective of your fund. And if someone wants that and you just deliver that, then there's no expectations gap. I think the problem comes when there's this expectation gap between the investor and the portfolio manager and the fund's outcome.
Yeah. Well, especially if the result is less than the expectation.
Of course.
You know,
So
it,
what do you have anything that you regret?
yeah, I guess like I hinted at earlier, just my from a leadership perspective, particularly when I started, you know, um, there and just in life general, like my regrets are similar in that, not dealing with certain situations early enough and hoping that, problems would go away and then I wouldn't have to either confront somebody with something, um, or make a difficult decision. And then the decision just becomes that much more difficult, the further you kick it down the road. And if I dealt earlier with certain situations, um, and yeah, in various aspects of the business, then the outcome would have been much, much better. And so that's one of my biggest regrets and biggest learnings, to be honest with you. Yeah.
Okay, great. So why don't we talk a little bit about, or do you have any advice for people entering, young people or people of any age? I mean, it's interesting. You said you started at 29 and you're working at a variety store, at a video store or whatever at the time. I mean, people that are many on the call today probably don't even know what a video store is. Like, you went to a video store?
Yeah, all true. Yeah.
Right.
Yeah.
And so, and yet that led you into the investment industry. So if you were giving advice to someone, a young person today, or anyone wanting to get into this industry, what would you tell them?
Yeah, a number of things, I guess. The first thing is don't be in such a rush. There seems to be this expectation that you should be making this much money by the time you're this old, or you should have a house by the time you're this old, which is ridiculously difficult now for young people, which we could also talk about, which I talk about a lot in my blog and my book anyways. But don't be in such a rush. Don't be afraid to try, jobs that are not completely aligned with where you think it is you want to be longer term. Like, it's impossible to know with certainty, where you will thrive and what kind of job you will thrive and where you will be happy. And so, but you have to target something and have an idea and move towards that. Don't be afraid to shift over every now and then, or as you go along and you discover new jobs or meet new people, and you learn by doing. You can't possibly know all the jobs out there.
Mm-hmm.
You can't possibly know what they're like unless you've tried them. And and you can always change your mind. Like, nothing is final. Like, there's no, oh, this decision is going to define the rest of my life. Well, maybe, probably not. And just the stress that is put on young people today. And we had the same stresses, I guess. It's but learn to not let that define you, I guess, and have fun with it. I mean, there's and take any job. Like, is I was in a video store. I've done all kinds of crazy jobs over the years. Deliver pizza for Domino's. I was 28 doing that. I loved it. It was so much fun. And you meet a lot of neat customers and the people you're working with. There's always something to learn. I mean, within reason, I guess. Yeah, I guess that's
good. All right, that's great. All right, let's transition. You're doing a lot of, it's funny. You led earlier saying you feel like you're doing more work now than you were doing when you were at Mackenzie. Let's kind of let's parse that out a little bit and talk to us about your blog and what it is that you're seeing in the work that you're doing.
Sure. Oh, well, maybe it says how little I was doing at Mackenzie. But
hey, listen, they're all on the call.
Yeah. But yeah, no, it's 7 days a week now. And so I started one of the reasons, well, I'll start with the blog first. When actually this is before I left Mackenzie. So June of 2022. Yeah. Or no. Yeah, June 2020. Started writing this because I'm reading the financial press all the time anyways, and I would take some notes for myself. And if you're just reading stuff, a lot of it's gone, unless you actually pick out certain things to write about. Well, that's interesting. That's not. Why is that? And think about what you think about what's in the financial press. And so then I thought I'll just start sending some of my thoughts in easy to understand terms to my wife and my three daughters. And they're in their 20s. And just so they can know what's going on in the world, like businesses. So, what are Starbucks sales and what's going on? But very short, very brief, but just try to get to the point. What's going on with GDP? What is GDP? Interest rates, like why our mortgage rates are what they are, and just again, very, very brief. And I started emailing. So then I added a couple of friends, and then my girl said that, can you add so and so on? And my wife said, oh, can you add my friend? Blah, blah, blah. They just started growing.
Yep.
Then I started getting emails from people that I didn't know because people were forwarding it on to others and saying, can you add me to your list? And yeah, and it started growing. So there's about 450 people on it right now. It's and I send it out maybe a couple of times a week. And so now my daughter is she's working for me, and she's built a website for it. And so now we're going public with it. Now we're going to sort of see if we can get some broader dissemination, if you will. And maybe I'll start finally posting on Twitter or something like that to see if I can get drive some more traffic to our website. And the website is called Paddington Capital Management. Management is mgmt.com. And so right now it's free. You can just go and read all the posts. And yeah, and it's I love doing it. I've always loved communicating and communicating clearly, like helping people to understand what's going on. Because when you do that, you empower people to make better decisions.
Yep.
Um, and then that's sort of related to my book. And so my book, I started writing 5 years ago. And but I'm still working, and it's really hard to write a book when you're working. And well, for me it is. And so the only time I really got to write was when we were on vacation. So pretty much all my vacation time for the last number of years, my wife's been really good about it. Maybe
You have a very patient family.
Yeah.
With
Yeah.
all your endeavors, I know.
Yeah. No, I mean they're fantastic, and they're very supportive. And but it was still taking too long, and that's factored into my decision to sort of semi-retire from Mackenzie last year, because I'm just getting so frustrated that I could not finish this book and get the word out. And the word is explaining how the monetary system works against most people. And I believe it's all with good intentions, policymakers. But I just think a lot of it is based on fallacious economic doctrine, in particular the wealth effect, which Ben Bernanke was a big proponent of this back in the early 2000s after the '01 recession.
Yep.
They all enjoyed the wealth effect that was resulting from the dot-com boom and the impact that was having on consumer spending and thus GDP. And then, when that blew up, they decided to create another bubble, another wealth effect, but this time with housing, and drive housing prices higher. People feel wealthier, use that as collateral for more money, to borrow more money, spend it, GDP rises. Well, yes, it does, but it's all based on debt. And, when your house is going up in value, there's no net wealth creation for society when a house price increases, right? It's just a redistribution of wealth. You're forcing the next generation to pay more for the exact same economic good that you bought. A house is not a productive asset, right? The example I've used is our house here in Mississauga. We bought it in '01. And it's, in nominal terms, it's like 5 times what we paid for. In real terms, it's still significant. But what did we do to deserve that extra wealth? What was our contribution to society? Zippo, nothing, right? We just happen to be older and benefited from these wealth effect policies of central banks that encourage,
Declining interest rates.
yeah, that encourage people to borrow and drive asset prices higher. And it's just wrong. And then the crisis hit, and then they started printing money hand over fist, buying assets for non-bank financial institutions to drive asset prices higher. And anytime the money supply increases, it extracts capital from the rest of the money already in existence, and also reduces the purchasing power of people's wages if they don't keep pace. And so just helping people understand how things really work, that one way of putting it is that, as one economist talks about it this way, that when you buy something with money, so if you go and buy a suit, the money is not your means of payment. The money is not what gave you the wherewithal to be able to go out there and buy a suit. The money is simply the medium of exchange for whatever was the wherewithal. What was it? What was your contribution to society? What capital did you produce? So let's say, in your case, Anthony, you produced a bike, right? Because you produced a bike, you now have the wherewithal to buy a suit, because you can sell your bike for money and then use the money to buy a suit.
Right.
Your bike, your capital that you produced, is temporarily stored up in your money, right? And so, but let's say you've got 10 bikes stored up in money that you're saving up, and all of a sudden the central bank doubles the money supply. Your money hasn't changed, but half of your bikes have been taken out of your money and put into the new money that was just created. So they extract your capital from you without your knowledge, without your permission. And so the name of the book is Capital Offence, and how some benefit at your expense. And it's not a conspiracy theory. And I don't believe that it was about just protecting the rich and stuff like that. I do believe that they actually believed, by driving interest rates to zero and driving asset prices through the roof, that the benefits over time would trickle down to everybody else.
Yeah.
Well, they haven't, and they won't. And not only that, but driving interest rates to levels that are below the natural rate, not the neutral rate. They're two different things, which we can talk about if you're interested, but below the natural rate of interest. The natural rate of interest is that which is determined by market forces, importantly with skin in the game, right? Those have got something to benefit and to lose.
Right.
They determine what interest rate is appropriate to either lend or to borrow. And when market forces determine that rate through the price discovery mechanism, then you get the most efficient allocation of scarce resources, of capital. And then you get the most productive economy. And then there's more wealth for everybody. But as you've seen over the years, productivity growth has been declining over the decades. And I believe, and you can see it start pretty much around 1971, when the US went off the gold standard. And the money supply started exploding higher.
Yeah.
It started distorting things. And you've seen each decade growth in developed economies, even in emerging markets now, getting lower and lower and lower. Mm-hmm. And I think it's because the money supply is growing higher and higher and higher, and the debt pile with it. And it won't be a good ending.
So what do you see happening here? I know in your blog you talk quite a bit about Canada, especially. But what do you see happening from an economic standpoint? And tied with that, how would you advise positioning money for all the money managers listening here?
Yeah, well, listen, there are a lot of smart money managers out there who don't need advice from me, that's for sure. But in terms of the economy, it's impossible to know what's going to happen, like in the short term, even in the medium term. I mean, look at last year. Some incredibly smart economists, strategists, blah, 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 were forecasting a recession in the US.
Yeah.
Didn't come. In large part, I guess, because of this crazy fiscal policy that they have down there. I mean, it's outrageous. And it's the same with, when I used to invest, we never believed that we could figure out what the broader stock market was going to do over any time period. Over longer time periods, you have some idea, but over shorter to medium term periods, it's impossible to know. And the same thing with our company share prices that we're investing in. All you have are fundamentals and price, and so that's what we would focus on. And so for a business, you look at the fundamentals. Are they strong? Do they have a good return on capital? Is it a very strong balance sheet? Is it a great corporate culture that's going to reinvest in the business over time? What's the valuation? Looks reasonable. Okay, we'll buy it. But we have no idea what it's going to do over the next 3-5 years. It depends what's going on in the broader marketplace. Depends what happens with interest rates. It depends what's in favor, what's not in favor. But if you have good fundamentals and a fair price over time, that will get you to a good point. So then if you've got 30 to 50 of those, then you can have more confidence, it's no guarantee, that you would get your clients to their long-term financial goals. But it requires a lot of patience and a lot of letting go and a lot of admitting to yourself that you don't know what's going to happen. Everyone likes to forecast things and whatnot, and I get it, but it just, it's impossible. And from an economic perspective, the fundamentals are not good. And definitely in terms of balance sheet, and just the tax policy, I guess, moving in the wrong direction. I know why. But
now you're speaking about Canada, right?
Well, no, just developed economy in general.
Yeah.
And so if you think of the fundamentals and then you think of the price as GDP, which is sort of all final spending.
Yes.
You think, well, if the fundamentals, like in the book, I use an example, like if you have a neighbor, if the fundamentals of your neighbor are good and that they've got a great job and they're very productive and every year they produce more and more stuff, that gives them the wherewithal to spend more and more money, right? And the more they produce, the more they can spend. That's good, right? So their GDP, their final spending, you can think of it that way. But if their spending, their final GDP, is a result of them taking on more and more debt every year, then you say, okay, yeah, the price is still rising. It looks good. But is it sustainable? Well, if they're doing it through debt, probably not. It's going to end. You don't know when. And people always find a way to take on more debt, right? And they keep it, and you're always amazed that it carries on. And that's the same thing with the economy. And so GDP is still rising despite the fact that the fundamentals are not good. And but when it stops, I don't know. And so the way, well, again, I really shouldn't give advice how to position for that. Just be careful, I mean, some people have a mix of, they like to go 25 equity, 25 fixed income, 25 gold, 25 maybe real estate or something like that, or other commodities. Be careful with real estate, obviously,
So you're concerned with real estate. You think asset prices generally are probably at the higher end of what might be the norm. And but it's hard to know when. It's hard to know what's gonna.
It's impossible to know when, right? And you just know that they're expensive. Housing prices are crazy expensive, particularly here in Canada, and and that was deliberate. A result of monetary policy and government policy in terms of first low interest rates and then super high immigration and driving housing prices higher. Somehow,
and now we see all the effects of that, where there's uprisings in many parts of the country, and there's not enough houses, and people are living in tents. We've had people here on our show talking about that, and we have our annual conference, which we'll have again this year in October on real estate in specific. If anyone has a question for Paul, please just scroll down to the bottom of your screen and click on the Q&A tab so that we can make sure that we address your questions here online. And Paul, is there anything that you would say you'd be looking for? I love the fact, you're right. Our entire industry, you turn on BNN, you turn on CNBC, everybody's got a forecast. This is going to happen next week, next month, in the next 6 months. The Fed's going to do this, the Fed's going to do that. And the reality is nobody knows.
No.
And so, but what you do know is this is a great company, and it actually generated cash, either this much or this much. You can actually do some sort of analysis to get close to what it is, and then think about whether that's sustainable or not. And that's where you're going to be able to focus on. And over the longer term, that company should do better, right?
Yeah.
So
that's the plan. And I should just say, when so many very, very smart people have forecasts and opinions of what's going to happen, I like to listen to these people. Well, some of them, and because you can learn a lot from them. It's not their forecast that I'm interested in, it's why they believe that, right? All the work that they've done behind the scenes and a lot of great work, really helpful. So, I listen to a number of these people, Rosenberg in particular, I like to listen to. There are a number of them out there.
And this reminds me of a comment from a good friend and good portfolio manager, Doug Raymond. He says, tell me what you think before you tell me what you know before you tell me what you think, because if you don't tell me what you know, I don't care about what you think.
Yeah, that's good. That's good.
Right? It's basically exactly, and that's what we want to focus on. It's always the why. Why do you get to a conclusion, and how did you get there? The conclusion you might disagree with, but if you don't know how we got there, it doesn't matter.
Exactly.
So I'll just quickly here throw up our poll so everybody can tell you what a great job you did on the session here, and there we go. So it'll come up pretty good, eh? And then could do that. And a couple of our questions we always like to ask our guests: favorite breakfast restaurant?
Yeah, I'm not a huge. Well, I like breakfast, but I just pretty simple. I like breakfast sandwiches. I just love breakfast sandwiches. But favorite breakfast place I've ever been to was my colleague and I, Matt Moody from Ivy. We were traveling in Norway. We're on the northwest coast. There's a place called Alesund. I think that's how you pronounce it. And so anyways, we had a meeting. And that morning when we woke up in the hotel, my buddy Matt said, oh, the breakfast is included. So we're, should we just go to the meeting? Let's check it out anyways. Might be okay. It was the best breakfast I've ever had in my life. We walked down and they had this huge table, and it's just these different types of breads with these massive big knives for cutting these. Europe knows how to do bread, and I love bread.
That's true.
And, beautiful fresh butter, and then these amazing cheeses and these cold cuts and salamis and then smoked salmon and eggs, and just, it was incredible. We went back about, I think it was maybe 3 years later. The whole trip, we spent more time thinking about that breakfast than doing our due diligence on the company. So yeah, that was special.
Shows how important the food is.
Yeah.
And so then what's your favorite book?
Yeah, so many, obviously. And but the one that always sticks out when people ask me that question is a book by Henry Hazlitt, and it's called Thinking as a Science. And it's a short book, which everyone likes to hear. And I took a bunch of notes from this book. I can send them to you after if you're interested, Anthony.
Yeah, do that.
But there's 3 books actually that short books that I have notes from, which I've sent to countless young people over the years when they were coming for either courtesy interviews or career advice, and yeah, so it's Henry Hazlitt is a fantastic author. Economics in One Lesson is perhaps his most famous book, which is also great. But thinking as a science, he talks about. He starts off just by saying, if you ever have a question about something, before you pick up a book or before you, I guess today, Google it and see what everyone else has to say about it, just stop and think about it for yourself. Right. And I've got a couple of quotes here. Blah, 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 blah. Yeah. Okay. So eternal vigilance is the price of an open mind. And, what he means there is that you can't be comfortable with your own thoughts. You always need to be questioning your thoughts and have doubts. And so you have to keep at it all the time. Never assume that you've got all the answers or that you have the right answer. Keep thinking about things and challenging yourself. And that's a lot of work, obviously. Learn to think longer before you advocate an opinion, which is sort of related to what we were just talking about.
Yeah.
Debate is one of the most potent sources of prejudice. When I read that, I couldn't agree more. I've always hated debate because debate is almost the exact opposite of intellectual honesty. Debate, your goal is to win. It's not about discovering truth, right? So avoid debate as much as you can, but have open discussion. And like on our Ivy team, and it's still the same way, we try to avoid that debate argument scenario or atmosphere as much as we can, as much as we could. But if you disagreed with somebody else, you better be saying so. But you're doing it in a respectful manner. Sorry, 1 second here. I got one more quote here, I think. Yeah, just again, the hazards of just reading what other people have to say. He said, learning to think by reading is like learning to draw by tracing.
Love it.
Yeah, so there are so many golden nuggets in that book that I would recommend to anybody to read at any age, not just people trying to get in the industry or whatever, but and what's so depressing is I think he wrote it in 1915 or something like that. I think he was 21 or 22 when he wrote it.
Wow.
Yeah, it's depressing.
Paul, wonderful discussion. Thanks for the many years of friendship and discussions, and
Likewise.
keep it up, and we'll stay in touch. Good luck. I can't wait for the book.
Well, thanks so much, Anthony. Great to see you.
All right. All the best, everyone.